Bruce, you have been saying that we are heading into recession in the U.S. So do you think the stock market is underpricing that at this point? It's
underpricing, and what's also underpriced is the credit markets, because if the credit markets and equity markets aren't pricing in recession, which I don't believe they are, then there's further and significant downside from here. So 3650 on S&P 500, I think it will have to test that, which is down another 8% from here, and out 100 basis points from here in high yield bonds is where we'll get to. But I think we'll actually get to a 10% yield in high yield bonds. So I think, yes, we're underpricing recession, and given the yield curve and what it's pricing in now, you can set your clock forward about 9 months from today, and I think that's when NEBR will designate this being a recession.
Well, why is the market not pricing this? It's very telegraphed with the yield curve, with what the Fed is saying.
Well, I think, S&P earnings right now for this calendar year is about $214, $215 per share. That's what we're on pace for. And if you look at what's expected for next year, it's $235 or $240. It's about a 15% increase in earnings. I think that's a pipe dream at this point, because I think earnings will actually contract. In every recession, earnings contracts about 20%. We think, but that's a nominal number, and so there's inflation, so it'll be less than that, maybe 7%. So it takes earnings down to 205, maybe 207 from 215 today, as opposed to 235, 240, what's being priced in. So there's a lot of downside from here yet.
Where do you think we are in the tightening cycle? The early stages, the middle stages, or the end? Because the market can't figure it out.
It's not so much where we are in the tightening cycle, because, and I hear you on that question, it's a great question, because I think there's more tightening to go, and I think we'll be 3.5%, 4% probably before it's all over. The point, though, and the more relevant point, is inflation as it trends down from 9% to 6%, and we're in that, on that trend now, we'll settle in around 4% throughout all of next calendar year. And so that takes away the Fed put, and it takes away the Fed pivot. And the markets haven't priced that in yet, because if you keep rates higher for longer, it means the recession won't be V-shaped, because the Fed will not be easing into a recession, as they always do when recessions hit.
The market has that wrong, you said.
But the market has that wrong. But the Fed will maintain the higher rates as you're in a recession in order to bring inflation down. And they're going to do that, and they said they're going to do that. And it's all about Powell's plan that he talked about at
He told
Jackson
us to expect
Hole.
pain.
Expect pain for consumer and businesses. So you take a survey of the consumer confidence, and you take a survey of CEO confidence, and the CEOs have real good insight as to what's happening with their companies. 81% of these CEOs now think there's a recession coming in the next year. 81%, and that's a record high number. So expect a recession, expect earnings to be considerably weaker, and expect credit spreads to blow out, because the pain plan is all about higher rates, it's about wider credit spreads, and it's about lower equity markets. And that's the only thing that's really going to
tighter conditions.
Weaken conditions, which will weaken demand. And when you weaken demand, you can bring prices back down. But the problem is prices can't really come down much, because you have a supply chain issue, both with energy, actually with labor, if we want to include that, but with energy, food, labor.
Structural
it's a real
things.
issue. There's structural things. And we're going from globalization to what I call regionalization as we move the supply chain back to regionalized areas, which is really good for the U.S. I love that long term, but in the short term, it's expensive.
So I guess the question now becomes how deep of a recession and how prolonged of a recession?
Well, prolonged, yes, but shallow. So it won't be deep. In 2008, 2009, it was a 4.5% economic contraction, and you saw something similar in 20, although it was even more V-shaped in terms of its recovery, because of the $5 trillion of stim money and quantitative easing that happened. So this time, the Fed, again, can't ease when the recession hits because of the high levels of inflation. And so it's going to be longer, but very shallow. And that's going to hit a lot of different industries across the board. Energy will probably do well. Pharma will probably do well. Utilities will do well. But there are a lot of sectors like retailers and the home builders and other segments of the marketplace that are going to be rather hard hit when it comes to earnings.